Okay, so like I said, we're going to start with maybe a little bit of a history lesson before we go into the nitty gritty, looking at a couple of indices and then some stock picks. But lead us off because you wanted to talk about the 1970s inflation period. Clearly, it's a topic du jour at the moment amongst market analysts, commentators, and the like.
It's funny, actually, one of your earlier viewers there was talking about the 70s inflation there and concerning there. So, look, the key there is with markets there is lots of noise, Carl, as we know. Sometimes we just got to look at the numbers. Um, they told us that we wouldn't have inflation there a couple of years ago, whereas if you look at the numbers, every time central banks print that type of money, inflation generally follows 9 times out of 10. So, if we look at inflation, every time inflation gets over 5%, how often has it sort of cooled off and disappeared? Unfortunately, the numbers aren't as aren't as positive as a lot of our market commentators are at the moment. So historically, once inflation gets to 5%, I think it's sort of almost in 2/3 of the cases there, it probably stayed there for 3 years, and sometimes longer. Obviously, the 70s was probably one of the worst, and but I think even sort of Stanley Druckenmiller in a recent interview there, he was talking about that if the Fed doesn't actually get in front, the Fed rate doesn't get in front of inflation, then it's almost like 100% rate. So I can't validate that view, but it does basically looking at historical CPI numbers and data there, it does suggest that if once inflation gets over 5%, it's a high risk of actually hanging around a bit longer than everyone thinks. And you read about history there, everyone thinks it'll return back, but it may not. So the odds, the numbers do actually, support maybe inflation being around. So the 70s is a really interesting period there. That was probably one of the longest inflationary periods. And if you actually look at the returns in that period, that's even more interesting there. So, I mean, like the value stocks was actually one of the strongest areas to be in. And the NASDAQ was actually one of the weakest markets over that period. So tells us not to be in growth stocks and to be in value stocks, and being in high dividend yielding stocks as well is a nice sort of safe place to be. That sort of tends to get you some pretty good returns over the decade. I think high yielders are around about 10.5. I think value stocks around 13.6. NASDAQ averaged around 4.3%, so not so good. The two interesting indexes, obviously energy. Energy averaged like 35.8, which is obviously supportive of what's already happening in the market. And precious metals was the other one actually, which has averaged around 24.6 over the decade there. So those are sort of two areas which were up there. The problem with precious metals and the energy was that some of those moves were enormous. Some of them were up 100, 200%, and other years they're sort of down negative. So the precious metals and the energy markets were very volatile, whereas equity markets were probably a little bit more stable. So just looking at this chart of the Dow there, that's obviously that's that sort of high inflationary period. So yes, we saw a bit of a correction there around 46% or something, but then obviously the bounce back is quite large as well. So we're talking 670 up to 1,026. So that's a nice sort of 40% rally in equities there, and a nice little another 30% drop, probably another 15-20% rally, a bit of a 10 or 15% drop, another 15-20% upside, another 15-20% drop, another big rally. So just tells us obviously in those high inflationary environments there, you have to be long assets, Carl. That's the reality. Is that if the inflation is here to stay, then you need to be sort of long property, you need to be long shares, you need to be long assets, because they have to sort of return you some, or getting you some returns, obviously, to fund the extra cost of living there. So just interesting periods. Equities, assets there. Get the initial sort of shock of inflation, but then the markets move around. You'll just see a bit of volatility there. Potentially, they might stand still. So dividends, high quality industrials is probably the safest place to be. So even if the worst case scenario is we get high inflation here and that's here to stay, and we don't get it under control, then equity can do quite well. It just have to be in the right areas. If it's not as bearish as that, we want to be still in the high quality end there. We still get a reasonable return. So just telling me here, probably the next few years there, you probably want to be a bit lighter on growth here. That's the reality, is what the numbers, what history is telling us anyway.